thought which is now coming up, and it's very recent that this discussion has again opened up, especially in news, is kind of moving away from actively managed funds to passively managed funds, which is the index funds that's coming in. And a lot of news is coming in that there's not too much alpha being created with active funds, etc. Over time, it's not about choosing which fund, it's just about choosing which type of asset you want to be on. We've seen it in the US. So is India following suit, or is there a different take on that?
So I think there is a place for passive funds and maybe some investors' portfolio. But the point is, if you are a long-term investor and you have confidence in a manager because of his strategy, because of his track record, because of his approach, process, whatever, that he can create, let's say, 200, 300 basis points of alpha. Actually, by going passive, you are losing out a phenomenal opportunity, because while it may sound it's only 200, 300 basis, but over the life of your investing journey, in that sense, it could make a really serious difference. Comparisons with the US are there, certainly. It's been a very successful market for the passive product providers there. I think India is a little different. I think there's still a lot more opportunity to create alpha. As the Indian fund managers have shown, I think last 25 years plus, alpha creation has been very strong. The reason why suddenly this chatter has really started and talk has started, because the last 18 months have been, and in that sense 18 months have been fairly atypical of the Indian stock market. I mean, it's been a very, very narrow market. Only the index stocks really doing well, and that also 10 stocks driving the index. And also, if you are a diversified portfolio, there have been enough reasons for you to probably have underperformed. But this is not something which will continue, and you will see as soon as the economy kind of recovers and people start to feel a little bit more positive about the longer term, you will see the market broadening and large number of companies will start to do well. And I think alpha creation from an industry perspective will happen. But if there are people who find a lot of difficulty in being able to identify these funds, which are the good funds, etc., or they may have shorter term calls, which I hope people are not taking that, but somebody wants to take that and he doesn't know how a particular fund will do in the short run, while it may do well in the long run, it may not do well. Whether it will do well in the short run, then maybe an ETF is a good way to invest. Anyway, we have to be invested in equities. So if you are not able to identify a good active manager, or you are in there for the short run, at least be there with the passives, whether it's an ETF or an index fund.
So we're discussing a lot on equity, but there is one question which again the investors have been asking from the debt side. And what we've also observed on the ETMONEY platform is that a lot of people have moved from credit risk sort of instruments and have kind of covered for space in the short duration funds or the liquid funds or the money market funds. This obviously is reciprocating the incidents which would have happened over the last 1 year in terms of certain defaults or late payments, etc., which has happened. As a fund manager, would your advice be to investors to kind of stay on the short run at the moment, or the short term funds at the moment, or is there some different strategy that can be played out?
Yeah, so I think most people invest in fixed income or debt for wealth preservation. There is a case to actually build wealth in fixed income as well, but that's a more aggressive, maybe a trading style or an investing style. So I'm addressing for people who are generally using it as wealth preservation. Wealth preservation means a reasonable return is what you want. There will be times when it will be time for duration, it will be times when it will be short duration, there will be times when you don't want interest rates to look like they're going the other way, so you just want to be in an overnight kind of fund. All those things can happen. Generally speaking, I think investors in the past have been well served by being in the short category, 2 to 3 year kind of a thing. It does not expose the investor to too many of the duration risks, etc. As an asset class, the high yield funds, which you talked about, credit, have become popular, and I think they have a role in the portfolio, despite whatever we are hearing. I mean, we all know that in markets, respond to any news. I mean, tomorrow
Right.
suddenly, mid-cap funds haven't been doing well on the equity side. Suddenly, money flow will stop.
Correct.
So, I think something similar is unfortunately happening on the credit side. And that is what it means is then, like in equities, if nobody buys mid-cap, they become cheaper. So there may be
Correct.
opportunity. Similarly, that's happening on the high yield or the credit side. Because people are not buying much of credit, there's not much demand for it. These stocks are available cheaper. These bonds are
Expensive,
available
yeah.
cheaper, and which is we measure in terms of the spread to the GSEC. I think they are at reasonably good levels, and I would think from again portfolio allocation perspective, some money can be invested because for some amount of risk at a time when the cycle is pricing is available to you, the spread is available. Next 2-3 years, you may actually make risk-adjusted superior return as compared to
Right.
AAA short-term fund.
Right. So we talk a lot about allocations when it comes to equity, large cap, small cap, mid cap, etc. In debt, would you suggest a similar allocation for people to look at as an ideal debt allocation? Is there something like that also available?
So there it is not large cap, small cap, mid cap.
Correct.
That's not the way we look at it. But yes, I think there's basically two things which we look at. One is duration on one end, and the other is credit rating, or in terms of basically the yield pickup when you buy lower rated paper. Essentially, it's a credit risk on one side and duration risk on the other. As I said, most investors looking for wealth preservation, and if they can get a slightly higher yield with reasonable amount of risk, that's where they would want to be. So I think a mix of short-term funds, a mix of some roll-down strategies, where you actually even cut down on even that small duration risk, and then some credit exposure through a little high-yield product. I think a mix these three, I think you are more or less
Right.
done. Apart from that, if you think that you will need money over the next year or so, typically because of tax reasons now, debt is seen as a more a 3-year kind of an instrument. If you think you will need some of the money and you need access to that, then a liquid or a ultra short kind of a category, which is basically to manage liquidity, also could be one of the other assets to look at. So I think if you do three, one roll down, one short term, and one short term with some credit, I think that builds your entire portfolio. And then from a wealth preservation perspective and from liquidity, you could look at a liquid or a ultra short term
Right.
category fund. And I think that's how the asset allocation would be.
I think there's one last question, just got reminded. A lot of interest is also coming in, or more of inquiries actually, on international funds. People are asking questions that I want to invest in stocks, but then that's a different field, right? So there's the other thing that's available of investing in funds which invest internationally. So Axis doesn't have one of those funds at the moment.
So we have one product, Growth Opportunities Fund, where we invest 30 to 35% of the corpus in international, in funds, in stocks directly. See, the strategy I explained to you, our strategy, I think
Correct.
great quality growth businesses
It follows
wealth.
all
So
across
if
this
you,
thing.
and these are not limited to India, and in fact, world's becoming a global village. Many of these international, the products which we use here today, whether it's Apple or the Netflix or the Googles and all that, they're not listed in India, right? We are consumers there, but we cannot
Right.
be owners of those businesses. So there is a case to invest in these great businesses globally. And so that's something which we've already started. And we are looking from an overall diversification perspective to some more, do some more of these products. So we filed for some more products. We will come to know as we get approvals and we launch these products. But we think international diversification has to be a very integrated part of the overall portfolio strategy. Today, the challenge is first to get people to move into equities.
Right.
So first debt funds, equity funds,
Right.
and then when then maturity comes in, to also provide products to take them global. I think over a period of time, you will see many such funds coming, and I think rightly so. I think
Right.
they have a significant role to play in investors' portfolios.
So do international funds also come with any additional risk as compared to what we have with Indian equity funds?
So I think the reason why we are going there is more to cut down the risk. Actually,
Okay.
you're getting into another currency, so you are
Right.
actually, you can say, are you taking a risk on some of these
Right.
currencies? Other way to say is that you are kind of addressing the risk of the rupee underperforming
Correct.
in that sense. So it works both ways. So it's diversification there. It's diversification on the economy. I think yes, India is a good growth economy. We will do well, but what if there will be times when the economy doesn't do that well, which is
Right.
like today when actually if you see some of the global economies, not all, but some of them are actually doing fairly well,
Right.
reflected in the stock markets there as well. So there is a good, one is opportunity, the other is diversification. I think they make great cases for you to be invested. I can't think of a real negative. I mean, if you really take a very narrow kind of a strategy and then put, let's say, all your money in a small country, where the economy is really very, very volatile, etc.
Right.
Yes, there could be some risk. But if you follow the basic principles, manage risk, buy good quality paper, whether fixed income or equity, diversify, have a process, and I think it will add to investors' portfolios.
So for a common investor to have a little bit of portion on
Yes,
international
I think
is
it's
definitely
a
not
process.
bad
We
idea.
have to get investors accept that fact that it helps, and then
Right.
slowly the allocations can be built up. Yes.
Fantastic. That's all, Mr. Nigam.
Thank you
Thank
very
you so
much.
much for having
Thank you.
me.
Thanks for having me. My pleasure, really, to be here.
So this was Mr. Chandresh Nigam from Axis Mutual Fund. I hope you liked what you heard from him, all the advices that he has given. Don't forget to subscribe to the ETMoney channel and smash that like button if you really enjoyed what we presented today. Happy investing to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.